Welcome to the Transparent FX Academy. In this video, we'll be making a multi-time frame analysis breakdown. We will be taking a pair, looking at what we have from a technical perspective, then looking at what hedge funds are doing from an order flow perspective on the pair, so COT perspective, commitment of traders, and we can see how we can actually capitalize on the next moves on this pair. But the point of the video is giving to you guys the tools to actually develop your own trading plan. So giving you guys basically the key concepts under which you actually have to develop a very complex and complete strategy, because things that like crossing over of the EMAs, very simple things, don't work in the market. We all know it. You have to develop a complete strategy that looks also at basically the order flow, technical analysis, and multiple timeframes. I know that many of you think that this is a little bit overwhelming, but if you can do it in a rule-based manner, it's actually pretty simple. So without further ado, I will invite you to check the video until the end because it will be very valuable. And if you do know who I am, I'm a top holder on the TRADINGVIEW platform, as well as running an educational program and swing trading full-time with my students. Okay, so let's make a full analysis here on AUD USD. This is kind of an update of the previous analysis that we have already made here to explain a very simple concept regarding COT data, if you remember. And I want to give an update on analysis basically that we have given and show you a possible opportunity, capitalizing opportunity that there can be in the future here on AUD USD, and that definitely we will be monitoring with students. And as usual, I will try to keep it as educational as possible in order for you to understand what you're supposed to be looking at when you're analyzing the market. Now, starting from what we had with the previous analysis, we had basically noticed that the market had created this perfect W formation. And during this move to the upside, hedge funds had closed some of their long positions during the move to the upside, therefore showing that they still weren't interested in the longs. Therefore, we could definitely expect a retracement for the completion of the W formation. And that is exactly what the market has given to us, basically a nice retracement. A retracement to where? To the 0.382 of the Fibonacci taken on the impulse. Now, when you want to measure a retracement in the market, you're always supposed to be basically taking your Fibonacci on the impulse. Okay, so if you want to measure the retracement, take it on the impulse. If you want to measure the next impulse, then take it on the retracement. But in this case, since we want to measure the retracement, just take it on the impulse. Now, if we take back all the levels, just to show you, what you can see is that basically the market retraced exactly to the 0.382, tested it a couple of times, and then continued with the next move to the upside, basically completing which pattern? Completing this impulse, correction, and impulse pattern to the upside. As it has already created, it had basically already completed this impulse, correction, and impulse. So basically we have impulse, correction, and impulse, right? Now, there is a difference between this impulse here and this impulse here, or better said, there is a difference between this retracement and this retracement. Why? Because here we have a standard retracement, impulse, correction, and the next impulse to the upside. But in this case, we have impulse, then we have a complex correction, so two waves to the downside, and then the market started the next impulse to the upside. So does this make any difference at all? Okay, having a complex correction or a regular correction, does it make difference? Yes, it does. Why? Because during this push to the upside, what we are creating this overextended W formation. Now, if you have an overextended W formation, what do you expect? You expect the market to make another move to the downside. So basically, by making this complex correction instead of a standard correction, what happens is that you definitely can be looking for a possible shorting opportunity if you will see proper confirmations from a lower time frame perspective. Now, if we look at what we have from a weekly perspective, so continuing with our directional analysis, just a quick reminder, make sure you comment below and you let me know which pairs you would like me to cover or topics that you would like me to cover in the next video. So what we can see from a weekly perspective is that the market is currently at this previous support, now turned resistance, right? We can clearly see it. This is a clear supply zone for the market. and we have this nice green candle confirming it. So inside of this area anyway, from a weekly perspective, we already expected the market to show us basically a reaction to the zone and a rejection to the downside. So basically we have the weekly time frame confirming what we have already seen from a pattern perspective on the daily time frame. So clear structure resistance. Now, if we go and see what is the situation from a COT perspective, now we know that from a daily perspective, the market has been moving to the upside all the time. That we already know it. But what we can see during that push to the upside, we can see that hedge funds were closing up their long positions again. They haven't been adding any longs. So again, more confirmations that we definitely can expect another retracement to the downside. As you can see, at the moment with the last reports, still no longs adding. So they're not interested in the move to the upside, which is very good. So basically how we can be approaching this from a swing trading perspective. You know that the market has a W formation on the daily time frame. You know that on the weekly, we definitely have resistance. What we can be doing, we can be looking on lower time frames, aka the 4-hour time frame, for possible shorting opportunities, because always keep in mind the monthly, weekly, and daily time frame are the time frames for direction. The 4-hour time frame is the time frame on which you're supposed to be looking for possible entries according to the rules of your own strategy. Now, obviously, I can't share the rules of my own strategy because that is part of the mentorship program, but what I can share with you and what I do share with you is a lot of education showing you how you can take the direction in the market and then implement a strategy from an entry perspective to then take your entries. So what we will be doing with students in this case is basically monitoring price action on the 4-hour time frame, all inside of this area. Why all inside of this area? Because if the market will continue higher, it will actually be even better. Now, why it will be even better? Because when the move to the upside will actually start, if it starts from higher, you have sold. If obviously the market will show one of our valid entries, it basically show a better risk to reward. It will have a better risk to reward because we will be shorting from higher. So basically, no matter if the market will create a valid opportunity around this area or higher, what we will be doing, we will be taking a nice short, and this short will have good risk to reward to the downside and good probabilities to actually play out. And that is what I suggest you to do as well. Now, obviously, you don't have the rules of my strategy, but you can be monitoring with the rules of your own strategy if they are tested. What does it mean? It means that if you have a strategy, it needs to be back tested and live tested. I've made a lot of videos about that. You can't just say, okay, my strategy is to sell as soon as I see a rejection candle. That is not a strategy, unless you have tested it in the past, at least 5 years in the past, and proven that basically it works as an entry perspective, given the rules that you use for direction, because you need rules for direction, entry, trade management, and obviously the risk management part. So how much you're going to risk per trade, what is the minimum risk to reward that you accept for your trades. That are all very important parts that you need in your strategy. If you don't have these parts in your strategy, then basically you don't have a strategy at all. And there is a big difference between a person that doesn't have all these parts in their strategy because they are gambling, they're not trading, and a person that has a very clear set of rules because that person is actually trading, he's not gambling. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free education and analysis for all of you, as well as going and checking out the mentorship program. You find the link in the description. It's a very complete program. You first get all the rules of my strategies, and then you trade them with me each and every day with entry, stops, take profits given to you guys in the daily market breakdown each and every day, as well as having me answering all questions that you have, including the weekends, directly on your student dashboard. So it's a very complete program. Go and check it out. The link is in the description, or you can go and check out the next video.